Regulations driving automotive. Automotive royalties are highly cash generative. Costs are out, profitable in the second half, and a long runway of applications for our technology.
Hello, you're watching Proactive. I'm joined by Seeing Machines CEO Paul McGlone and CFO Martin Ive. Paul, Martin, very good to speak with you. Following second quarter KPIs, Seeing Machines released half-year trading update this morning. Paul, what are the key takeaways for investors from the trading update?
Thanks, Stephen. Well, look, the most important point, I think, is that the results are very much looking backwards. What's really important for us is that we're just 6 months away from the GSR regulations and the commencement of a material ramp in our royalty business. But as far as the results just published, 67% growth in units on road, which is pretty strong, to just over 4.8 million. Annual recurring revenue up to $14 million US dollars. Operating costs have been reduced, and we don't see any reason to adjust those upwards as we look forward. Adjusted EBITDA loss is narrowing, and it's narrowed significantly in the results that we've just posted, and we expect that to move into positive adjusted EBITDA in this current quarter. So this is really the inflection point that we've been preparing for now for the last few years.
Paul, you reported the revenue is down year on year. Can you highlight the reasons for that reduction?
Yeah, it's really more about timing, and it's not anything to do with demand, so to speak. One key element is that we had an exclusive license arrangement with Magna that I think everybody is very well aware of. So there is a proportion of revenue for license in the prior period's results that isn't in the last half's results. So that's significant. But also on the engineering revenue side, we've had a number of programs that are transitioning into production, which is actually fantastic because it moves us into the high margin zone. But NRE for the period was also lower, essentially because of that. Now, we're talking about roughly a $6 million difference between the first half of 25 and the half that we've just posted for those two items. So that's pretty key. But as I say, we are expecting materially higher royalty volumes from here on in until the end of the fiscal year. What I will say about the first half, and whilst we did post a 13% increase in volume of royalties, there were two programs that one in the US and one in Europe that were materially down on our expectations, and they accounted for about roughly 100,000 units. So we could have expected to be about 100,000 units higher. One of those is essentially a reporting issue with a European OEM, and we expect that will correct itself in Q3. And the other is to do with parts shortages for a particular program in the US due to a fire. And we also expect that to correct itself as well.
Martin, the cash balance at the end of December was $3.4 million. Can you highlight the major movements during the period?
Yeah, cash reduced by about $19 million during the first half. Around 13 million of that related purely to operating performance, but was weighted more to the first quarter. And we saw an improvement in Q2 with higher levels of Guardian sales and associated recurring revenue. And as royalties ramp up in the second half, together with that incremental contribution from Guardian, we expect adjusted EBITDA to turn positive in Q3, which will then translate into improving cash flow from operations and cash generation. Working capital also in the first half increased by about $5 million, primarily related to inventory. Now that's a timing related issue, and we expect it will unwind as we go through the second half as deliveries increase and inventory normalizes, and that will provide a cash tailwind. We also made a $1 million contracted deferred consideration payment relating to AFIS. Importantly, though, in early January, we received $14.1 million from one of our guaranteed royalty programs, as we have announced previously. We had anticipated the receipt of that amount in December. So whilst the reported December cash balance was temporarily lower, that position strengthened significantly at the start of the second half.
Martin, given the additional $14.1 million, how do you think about the balance sheet? Do you see any need to raise additional funds? Does the company need to raise capital?
We don't anticipate the need to raise capital. Our focus is on delivering positive adjusted EBITDA in Q3 and positive cash flow over the second half of FY26. The accelerated $14.1 million royalty receipt strengthens the balance sheet at an important point as automotive royalties ramp ahead of the GSR implementation. To provide some additional headroom and flexibility during that ramp-up period, we are progressing the establishment of a receivables funding facility and expect that to be in place before the end of March. A facility like this improves cash conversion efficiency of the quarterly royalty cycle. That's particularly important as we enter a period of accelerating royalty growth. Just turning to the medium-term balance sheet, the convertible loan note matures in October. As previously outlined, we have been actively assessing all of our options and have now commenced a formal refinancing process with our advisors in the UK. We're targeting completion of that by the end of June, and we will update the market as that process progresses.
You mentioned the July 2026 EU GSR deadline, Martin. How significant is it?
Well, it's a structural regulatory step change. So from the 7th of July 2026, camera-based DMS is required in all new EU vehicle registrations, so basically all new vehicles sold. The OEM compliance programs are already well underway and they're moving into production. And as they ramp into full compliance ahead of the deadline, we expect a material uplift in royalty volumes in the second half. Now, as I said earlier, this ramp up will be the major factor in generating positive cash flow in Q3 and Q4, and then through the rest of the calendar year.
You've mentioned in previous statements that this is the turning point for profitability. Is that still the case?
Yes, it is. The cost base has been reset. As Paul mentioned, there's no requirement for us to increase costs to meet any obligations or generate revenue as we go through that period to getting to profitability. The engineering heavy phase for auto is at the very tail end as we get to production of all of those compliance programs. And, the auto production scale is beginning with those high margin royalties, as we've seen with the increase in auto volumes through the first half. And the Guardian sales and the associated recurring revenue are increasing. So we expect positive adjusted EBITDA in Q3 and then across all of the second half.
Paul, what should investors focus on for the rest of the financial year?
Well, look, for me, there are really three important areas: royalty volume and the acceleration of those royalties over Q3 and Q4. I mean, we've just had a 67% year-on-year growth in royalties. That's pretty material. I would note also that our competitor recently announced strong royalty growth in the same period. So there's definitely an underlying momentum towards high growth rates. But I think what's really important is that this growth rate will accelerate further over the course of this second half. So that's the first point. In Guardian, we posted a better number for the previous quarter. The Guardian pipeline is continuing to grow. We've got some very real and interesting opportunities across the board, actually, in each of the key regions in which we operate. So we have a higher degree of confidence in getting to our sort of stated target of 6,000 units a quarter, certainly over the balance of this second half. And the third thing is a positive adjusted EBITDA in Q3 and positive cash flow across the second half of FY26. And I guess supporting that, the short-term funding that Martin has talked about, and a high degree of confidence around refining the convertible note.
Well, thanks, Paul and Martin. Any closing comments?
Look, I just, without repeating those 3 points again, I think one of the interesting things for us is that at CES we talked about our next generation 3D cabin perception mapping. Now this platform opens up really material opportunities for us. We're way ahead of the pack in terms of this technology. No one else is doing anything like it. And so, from a technical or a technology point of view, this advancement, creating this sort of real-time digital reconstruction of the cabin, it really enables a great number of things to occur. It enables scalable deployment across our automotive customers. It enables us to accelerate in this new area of mobility that we announced most recently, and we're already seeing traction there. But importantly, we think this will provide the platform for us, and some of the early conversations we have had with third parties sort of confirm this, that in digital cockpits and areas like the emerging robotics applications, this is where this technology is going, and we've got a very, very strong platform based on current capability, current technology to get there. So, final word, regulations driving automotive. Automotive royalties are highly cash generative. Costs are out, profitable in the second half, and a long runway of applications for our technology.
Paul, Martin, thank you very much for taking the time to speak with us today.
Thanks, Stephen.
Thanks, Stephen.
Seeing Machines CEO Paul McGlone and CFO Martin Ive.